everyone, and welcome to Boss Advisory. Today we're going to learn about 5 financial realities that banks want you to overlook. Any economy depends on its banks. In reality, every bank, including the Federal Reserve, generates money. What if I told you that each bank has the authority to issue new currency? There is an easier approach that theoretically starting a bank to start producing money. Why do you always start a bank with so much money? Become a Bitcoin billionaire once you can launch a cryptocurrency season. That is, at least, what has been taking place lately. If you think cryptocurrency is a hoax, you probably don't understand how the banking system works. Here in this video, we're going to take a look at 5 financial myths that banks don't want you to be aware of because, as Henry Ford once remarked, it's good enough that Americans don't understand our banking and financial systems because if they did, the banking system might come to an end. Number 1. Keeping your money in the bank is not a good idea. At first glance, it would appear that you would receive at least a few percent of interest if you deposited your funds in a bank, for it to make any sense, right? If you check out the figures, though it's clear that this is far from the case, the best institutions like the Citibank, for instance, provide essentially less than 0.5%. Even if interest rates are at their lowest, some banks do offer higher rates, but they're still less than 1%. Now consider, when inflation is 2.5%, your money grows by 0.5%. Your wealth's fundamental value is essentially declining yearly. It would be far better for you to use that money now than to keep it in a bank. Your money's purchasing power in a few years will be significantly lower than it is today. And when inflation is as extreme as it is right now, for instance, asset prices like stocks and homes grow exponentially. The previous year or two has shown us that banks are places to park your money rather than make money. Number 2. Any bank is free to print money out of thin air. Since the Fed is the only bank that is permitted to generate money, you probably won't believe me if I say that banks do so. It is the sole organization with legal access to that printing press and the source of the dollar. However, this is how the banking system functions. Every bank in the nation or perhaps the entire planet is permitted to manufacture money to a certain extent based on the amount that customers have placed there. What do you suppose a bank will do with $1,000 that you deposit there? It serves no purpose to maintain it. Even your pitiful 0.5% wouldn't be paid to you by them. As a result, the bank lends your money to someone else so they can, say, buy a car. Additionally, it collects interests, which is frequently much higher than the 0.5% that a typical credit card pays you. 20% interest is charged. The difference between those two amounts and what the bank pays you is enormous. The key aspect is that the bank won't disclose who it will lend your money to. The bank will always show you that your money is still in the bank whenever you check your account. You are free to withdraw it however you like. As part of the practice known as fractional reserve banking, banks are only permitted to keep 10% of the money that is deposited with them and must lend the remaining 90% to other parties. To make the total $1,900, the bank produces another $900 and lends it to someone else. The bank made up $900 on the spot. It's not as challenging as you may imagine. Number 3. You can make money by taking out bank loans and investing the money elsewhere. July 2012 is when the $6 million Palo Alto was paid for by Mark Zuckerberg. That is a 30-year distance of 3 miles from Facebook's headquarters. He was the 40th richest person in the world at the age of 28 and had an estimated net worth of $15.6 billion at that time. Why would you take on debt when you have billions of dollars and can easily afford it is the question. He could easily spend $6 million in cash to purchase a dozen properties if he so desired without placing a bet. Hence, why not? It's free cash. Sounds absurd. I get it. When you're already a millionaire, who would give you free money? Why would someone offer someone else free money after all? And everything has to do with interest rates, unless it's charity. Recall how we said banks' low returns made it pointless to retain money there because they can't even fight inflation? Thus, you are suffering a loss. In this case, however, the situation is reversed. The US inflation rate is between 2.5 and 3%. Therefore, any borrowing capacity that is below the rate of inflation is regarded as free money. The rate on Zuckerberg's mortgage was little more than 1%. The banks are the losers if you do the math. You don't need to be a math genius to figure it out because the mortgage rate is lower than inflation. Let's imagine, for illustration purposes, that you borrowed $1 million at a 1% interest rate. Before the epidemic, the savings account's average rate of return was 2.4%. It is currently less than 1. If we stick with 2.4%, you would earn $24,000 annually if you deposited $1 million in a different bank. You merely need to pay the bank that gave you the money a monthly payment of $10,500. Consider what would happen if you did that with $100 million. Or how about $1 billion? Since you can borrow money for nothing, there is no reason to keep your own money in a savings account when you can utilize it for more profitable endeavors. In fact, since the difference is so minor, when we are talking about small sums of money, this may not make sense. Playing around with 1, 2, or half of 1% when dealing with huge numbers, however, might possibly mean thousands of dollars. Number 4. Your rate decreases as your wealth increases. Keep in mind that banks are businesses just like any other, whose goal is to maximize profit, not charitable organizations. They are accountable to their shareholders, and they won't survive if their business strategy isn't going to be profitable. They feel far more at ease lending money to an affluent person than a poor person because of this. For instance, when you're a billionaire, no one is concerned that you might fail on your lawn loan. So the banks can rest easy. Additionally, you can easily sell a portion of your firm to pay off your mortgage if something were to prevent you from making your regular payments. That qualifies as lending you money, almost without risk. In actuality, this is how the banking system developed over the ages, when banks would only do business with the nobility, with individuals who had wealth and assets that continuously generated income, like land. Compare that with a typical employee who may become sick, be unable to work, or just lose his job. Lending you money is quite risky if you're barely scraping by. I am aware that it is simple to condemn banks for such, but consider, if your friend barely makes any money, or if your friend has a business, would you feel comfortable lending them money? Despite how harsh this may sound, the latter is probably the case. You need to perform better if you want to get a lower mortgage rate, a lower credit card rate, or just better terms when borrowing money. Economically first, banks also provide such a low mortgage rate to build trust with wealthy people so that in the future they may turn to them for larger loans, such as those needed for businesses. It benefits both parties. Blockchain and cryptocurrency technologies, for example, promise to alter this and democratize banking. Financial services are now available to everyone thanks to democratization of banking. Number 5. Credit cards are banks' nuclear weapons. 70% of Americans with credit card debts admit they can't pay it off this year when compared to a century ago. Consider for a moment what that means. Your charge card balance not the same as a mortgage. It doesn't grow at 3.5% annually. It's probably around 20%. What makes you believe that you will be able to pay off your credit card debt in a few months when it has significantly increased if you are unable to do it now? In other words, 70% of Americans are on the verge of becoming debt slaves. 56% of those surveyed indicate they've carried credit card debt for at least a year, and the majority expect to keep carrying it for years to come. Nearly 20% of those surveyed predicted it will take them longer than 3 years to pay off their debt. However, over 8% of the respondents claim that they are unsure of their ability to make payments. And because most individuals spend their money without considering how they would pay it back, that is how banks typically make their fortunes. Even if they can't afford it, they are prepared to maintain the quality of living they are accustomed to. Banks phone you repeatedly to try to sell you a brand new credit card because of this. Don't misunderstand me. To improve your credit card score, using credit cards properly is fantastic. But if you're not financially responsible, you shouldn't fall into that trap. We all aim to be financially stable. So here's one of the millennial ways you can try to work on that allows you to make profitable money online right from the comfort of your own home. And as a matter of fact, you can take it with you anywhere you go. If that interests you, make sure to click the first link down below to find out. Thank you guys so much for watching Boss Advisory, and if you haven't yet, be sure to subscribe, give this video a big thumbs up, and hit the bell so you get notified on every new incredible content we make for you. Have a wonderful day, and see you on the next one.